Hello and welcome to another video on current and contingent liabilities. We'll look at various situations at year end and decide if we need to do any journal entries, that's the accrual entries, and how we will present the liabilities in the balance sheet. So with that, let's get started with problem 13-4. Let's read the opening information presented to us. The unadjusted trial balance of manufacturing equitable at December 31st, 2021, the end of its fiscal year, included the following account balances. Manufacturing's 2021 financial statements were issued on April 1st, 22. So 3 months after the year end, the financial statements have been issued. We have accounts receivable, accounts payable, 10% notes payable to bank, and mortgage notes payable of 1.2 million. Now, the other information given to us, the first one states that the bank note issued on August 1st, 2021 are due on July 31st, 2022 and pay interest at the rate of 10% payable at maturity. So at December 31st, we will have to do an accrual journal entry. So instead of date, I'm just writing, identifying the information over here as A. We have to do an accrual journal entry to accrue the interest. So the note was issued on August 1st. So August 1st through December 31st. Our journal entry is going to be fairly straightforward. It's interest expense debit, interest payable credit. The bank note is $600,000. So it's going to be $600,000 times 10% times 5/12. That's because I had it for 5 months, August 1st to December 31st. That's $25,000. So that's fairly straightforward. Let's look at the second one. The mortgage note is due on March 1st, 2022. This mortgage note payable is 1.2 million. It's due next year, which means in the balance sheet, I need to classify it as a current liability. Let's see what additional information is given. Interest is 9% that has been paid up to December 31st. So they're saying that the interest has been paid. I don't need to do any accrual entry. They're saying, and also that 9% is the realistic rate, so nothing else to be concerned there. Manufacturing intended at December 31st to refinance a note on its due date with a new 10-year mortgage note. So they plan to, they've said they want to, this is their intention. The intention is to refinance it with another long-term liability. Therefore, they don't want to classify it as a current liability. What's the second condition that needs to be met? By the date of issue, they should have made arrangements. So let's see. In fact, on March 1st, manufacturing paid $250,000 in cash on the principal, which means they repaid $250,000, and the balance of $950,000 was actually refinanced with long-term liability, with another long-term note. So when we get to that point, we'll see how to do the presentation in the balance sheet. No journal entry is needed now because at December 31st, nothing has been done. Interest was paid, they've not done anything. At December 31st, all we have is their intention. So here we have no journal entry. Included in the accounts receivable balance at December 31st, 2021 were two subsidiary accounts that had been overpaid and have a credit balance of $18,000. The customers were of two major, the accounts were of two major customers who were expected to order more merchandise from manufacturing and apply the overpayments to those future payments. So here we have a situation where a customer has overpaid. Two customers have overpaid us. They paid $18,000 more. So when we got the money, the journal entry was cash debit, accounts receivable, credit. But the accounts receivable now has a credit balance of $18,000. So when they pay up their account, at best it should get down to zero because they paid it off, but they paid more. So our journal entry was cash debit, accounts receivable, credit. We now have a credit balance on accounts receivable, which we should not because it's an asset. Now, ordinarily, you would have to refund the money. The journal entry would be accounts receivable, debit, cash, credit, $18,000 to wipe it out. But in this case, the customer tells us, keep the money because I'm going to have another order that I'm going to place very soon. So I do need to debit accounts receivable for the 18,000 in order to bring it up to the zero balance, because to show that they don't owe us any money. That 18,000 that they overpaid us, it's towards future purchases. So at this point of time, it is unearned revenues of $18,000. So when we got the extra 18,000, the journal entry should have been cash debit, unearned revenue credit, but we credited accounts receivable. So that's the adjustment we are making over here. And finally, in D, we are told on November 1st, 2021, manufacturing rented a portion of its factory to a tenant for $30,000 per year, payable in advance. So the customer paid the entire $30,000. What should the journal entry have been? Cash debit, unearned rent revenue credit, 30,000. The payment for the 12 months rent, the payment for the 12 months ended October 31st, 2022. That's the next day they're saying. This was received as required and was credited to rent revenue. So when we received the money, when the tenant signed the lease on November 1st, 2021, the journal entry we did was cash debit, rent revenue credit for the entire 30,000. 30,000 is not rent revenue. Only 2 months, November and December, is rent revenue. So the remaining 10 months, we need to do an adjusting entry, just like we did over here. So we will debit rent revenue because we recognized 12 months of rent instead of just 2 months of rent. So we do the adjustment for the 10 months of rent, and we credit unearned rent revenue. So 30,000 times 10 over 12. That's because 10 months I still have not earned it. Only 2 months, November and December, is earned, so I can leave it as rent revenue. But the remainder I need to debit, and I need to credit unearned rent revenue. So now that I've done all of these, the adjusting entries, for A through D, B did not require an adjusting entry. That was information that I'll use over here in the balance sheet. I now can proceed to the second part, where we've been asked to prepare the balance sheet indicating which items I'll classify as current and which ones will be long-term. So let me go through the list over here. Accounts receivable is an asset. It doesn't come in the balance sheet section. It does come in the balance sheet, but not in the liability section of the balance sheet. I'm just concerned about the liabilities. I'm preparing a partial balance sheet. So I'm going to number these items just so that I can keep a track of the items for no other reason. In a balance sheet, you will number items, nor would you put alphabets over here instead of dates. I'm just doing it for my convenience to explain it. So with current liabilities, the first one I have is accounts payable. That number I have at 35,000. Okay. The accounts payable is 35,000. That's what it was in the balance sheet. Accounts payable was not affected over here, so it stays at 35,000. The second one I have is that 10% notes payable, which is $600,000. I haven't paid any of that, so that's still there in my books, $600,000. Okay, and it is a current liability, so I leave that over there. I have mortgage notes payable. The mortgage notes payable I have are this mortgage notes payable, 1.2 million. 250,000 was paid in March, on March 1st. So that portion I'll classify as current liability. Remember, current liability is due within the next 1 year of the operating cycle, and we intend to use current assets to pay it off. So I now know that I did use cash to pay off that 250. So that portion is current. So the remainder, which is refinanced, 950,000, is going to be listed under your long-term liabilities. So this 1.2 million, 250 is current, 950 is long-term. Okay. Continuing on, I have interest payable, that's 25,000. I have unearned revenues, and that number is 18,000. And I have unearned rent revenues, and that is 25,000, giving me total current liabilities of 953,000. When I add that to my total long-term liabilities, there was only one. My total liabilities is 1,903,000. So the only challenge in preparing this balance sheet was this notes payable, the mortgage notes payable, the one that had no journal entry, but it had information that told me that 250 had to be current and 950 would be classified as long term. Remember the danger of classifying the all 1.2 million as current liability? That's going to really mess up your current ratio. Current ratio is current assets divided by current liabilities. Working capital is current assets minus current liabilities. You don't want to subtract this 950 when you know you're going to refinance it. And in fact, after the balance sheet date, the fiscal year end, but before it was issued, I have that clarification stating that I did refinance. Therefore, I'm fully within my rights to classify this as a long-term liability. So this is a quick example of how we can have various information, events that happen after the balance sheet date that affects how we present information in our balance sheet.